All right, so here's the thing. Rate cuts, again, I said it earlier, without recessions have always seen the market higher a year later. I want to bring in now UBS, their Global Wealth Management, head of Global Equity Strategies, Nadia Lovell. Nadia, here's the thing. Lots of folks are worried the Fed may have missed a lot of things, that they may be moving too quickly, and that maybe they can't even do enough now to stave off recession, which is in a pipeline. Your thoughts?
You know, Charles, to clarify, we're not part of that doom and gloom club. You know, we've been saying since June that we expected the Fed to cut, that we thought that the economy would be slowing down, particularly on the labor market side, and we're seeing that. So our view hasn't changed. We're still looking for 25 basis points cut next week. Now, the debate is, could you get 50? We'll see. Tomorrow we'll get the annual benchmark revisions. We'll see. Remember last year, that's what drove that 50 basis points cut. Not our base case, but we think that you get a string of cuts for 100 basis points through January.
And this is the table I wanted to share with the audience. Again, when the Fed cuts and there's still expansion, not recession, a year later the market's always higher, right? 12 months later it's always higher. That's a 100% ratio. Even 3 months later, a month later, all the time you get maybe a little bump in the road, but then it's higher. Let's talk about some other drivers you're looking for at this market while you're still bullish here. Earnings, profit margins, and a resilient economy. I guess this is the question mark. Is it really resilient, or is it just a few people like you, very rich folks, carrying the entire market?
Well, I don't think it's very rich folks like me, because I don't put myself in that category. However, I do think like the American consumer has been resilient. I mean, we've heard throughout the conference season last week at an industry conference, all the companies are saying that the consumer is still chugging along.
So when you see like a Macy's, for instance, come out with a strong earnings report, that's a sign that it's not just, again, rich folks.
Exactly. And so we do know that the lower end consumer has been under pressure, but is there no acceleration in that pressure? So while we think the economy is going to slow down, again, it's not falling off of a cliff. It's coming back below trend line growth. So we're looking for 1.5%, 1.8%, not calling for a recession.
No, well, these are your targets going to June of next year. Your base case 6,800, your upside 75. What gets us 75? What extra has to happen for that?
I think if you see that reacceleration of growth back up to above trend, you know, something with a 2% handle, maybe closer to 2.5% handle. And also the reality is the AI trade in terms of investment. If we see an acceleration in capex, we're already looking for $500 billion for next year. If we get more than that, and then we have a cyclical recovery, easy monetary policy, that could get us up to 75.
That's a nice mix right there.
Yeah.
Let's talk about where you want to be positioned. This is where you've been for a while. I mean, obviously you've done extraordinary. It's working. I'm not complaining. Utilities hit a little bit of a bump in the road here recently. I mean, maybe they got ahead of themselves on a relative basis, right? But you're saying, essentially, it seems like you're just saying, why fight it?
Look, stay, structurally long in tech and consumer services and also utilities. Why? Because of that AI story still remains alive. Now, do you add in some cyclical exposure? We've been playing that through the blanks, particularly in financials. You look to add on, on pullbacks there as well, which we did get a bit last week, because that's not only a cyclical story. We're also going to see benefits from lower rates, as well as the fact that you're seeing a pickup in M&A. Seeing some deals today.
So, okay, we got XLF, right? And to your point, it pulled back a little bit, but the trend line is pretty obvious there. Within there, I mean, the big banks seem to be standing out within there. Is there any sort of niche in there, or you just say maybe just stick with the XLF?
I think you stick with the big banks, some of also the alternative asset management. Remember, they've built up the pipeline over the last few years and are looking to unlock value there. So we think that those will eventually be the winners as we head into 2026.
What about the rest of the cyclical trade? I mean, if you think the economy is holding up pretty good, why not branch off? Because we are seeing a little bit of broadening out of the rally. Not a lot, and then it's not sustained, right? We get a couple of days and a couple down days.
You are seeing small cap catch a bid. Not too surprising, because small cap tends to be interest rate sensitive, so people are cycling into that. We think it's a little bit too early to go full force, because remember, we do expect the economy to slow down, not into a recession, and sort of that re-acceleration needs to happen for the small cap rallies to be more sustainable and flow through the earnings growth.
Any wild cards for you, like tariffs or anything like that? I mean, there's a lot of court decisions that are still lingering out there. Could that change your mind?
Look, some investors are still climbing that wall of worry. We're less concerned about tariffs. We consistently say that we think that the effective tariffs will settle around 15%. Even though we have court challenges, we all know the president has other alternative routes in which he can rebuild that tariff agenda, whether it's Section 232 or some other means to do that. So we're less concerned about that, and companies are weathering the storm.
You're great, Nadia. Thank you very much. And you knew yellow was the theme of the day.